Corporate finance practice problem using Excel. We're going to be calculating bond value with different yield rates. This is the second problem of a similar format. Get ready. It's time to take your chance with corporate finance. Here we are in our Excel worksheet. If you have access to the Excel worksheet and would like to follow along, note that we are in the practice tab as opposed to the example tab. The example tab in essence being an answer key. We're going to have the information on the left-hand side, populate that information into the blue area on the right-hand side, running a few different scenarios with different yield rates down below. Note that we have done a problem similar to this in the past, therefore this time we're going to do this a bit quicker than the last problem we have seen in the past. Information then up top. This is the information you can imagine if you actually had a paper bond. You can kind of imagine this information to be gotten from the actual bond itself. And this information down below is going to be market type of information, the expectations of the market. So up top, we're going to say the par value, we're going to say is the 1,000. That'll be basically our standard par value. The percent, we're going to say is 18%. It matures in 20 years. That you can get, once again, imagining actually on a bond. And then we have the basically market or yield. These are the market expectations. So now we have the yield 11, 10, and 20. So knowing this, imagining the circumstance, if we imagine ourselves as the issuer of the bond, we're the corporation trying to issue the bond then, if we issue the bond up top and we have, like if we made the bond at the exact point in time, then we would try to get, as the time we issue, we would try to get the interest rate to match the market rate, and therefore we would simply issue it at the $1,000. If, on the other hand, its time has passed and the market is perceiving a rate that is different than what is on the bond, then if the market rate is something below what's on the bond rate, you can imagine our position as the seller of the bond. We would be saying, hey, look, you can go buy bonds elsewhere, but you're not going to get 18% on the bond. So we're going to sell you our bond, not for $1,000, but we're actually going to increase the price, have a premium on it, selling it for more than $1,000. If, on the other hand, we have a rate out on the market expectations are higher than what we have on the bond, then when we try to sell our $1,000 bond, you can imagine the market then saying, hey, look, I can get another bond that's similar and get a 20% return. Why would I buy your bond? And we'll have to say, okay, we'll buy it because I can't change the interest rate, but possibly I'll sell it for something less than the $1,000, and we would have to sell it then at a discount. So let's actually now calculate those amounts with these three different yield rates down below, three different market rates. Starting with the 11%, I'm going to make this one green. So we have to do two things to calculate the bond. One, typically an annuity. We're going to bring the annuity payments back to the current period. We're going to say these are paid yearly, so yearly. And then we'll take back the present value of one, the 1,000 at the end of the term. So let's do the annuity first. I'm going to break this formula out. P times 1 minus 1 plus R to the negative N over R. We'll break that out into a table type of format. We're going to put P all the way to the right-hand side. That's going to be the 1,000 times the 18%. That's where the 18% comes into play. That's how we calculate basically the payments that we are going to be having. Then I'm going to pull the numerator into the inside, starting with 1. And then I'm going to pull this component into the inner column here, 1 plus R to the N or negative N. So 1 R, then 8 or 11%. That's why I made it green. I almost picked up the 18, but then I was like, no, it's not green. So then home tab numbers and percentify, home tab font underline, summing it up with the trusty sum function equals SUM, shift 9 and summing that up, percentifying that cell, home tab numbers percentify, taking it to the power of the number of periods, that being negative 20 in this case, underlining that, home tab font underline. I'm going to then bring this to the outer column by saying this equals the 111% shift 6 caret negative 20 to the power of negative 20. In other words, adding decimals so we can see some action happening here. Home tab numbers, decimalize. Where's the action? There's the action. And then home tab font underline. Then we can subtract out. That'll be the entire numerator now. So if we subtract out the 1 minus that whole thing, there's our numerator. More action needed. Home tab numbers, decimalize. So we can see some action. And then denominator is going to be the rate, which is the 11%. Picking up the 11%. Percentifying home tab numbers, percentify, home tab font underline. Numerator and denominator, you know what we do when we have those two down to one number. Take the numerator divided by the denominator. Percentify, home tab numbers. Actually, I'm going to decimalize it. Underline, home tab, font, underline. And finally, we can multiply out the outer column. Outer column multiplied out. There we have it. Let's add a couple pennies. Home tab, numbers, couple pennies. There's 40 cents on the pennies, 40 pennies. Then we would, if we then present value the present value of 1 and add those together, that would be what we would consider to be the market price of the bond here. But first, we're going to calculate this again a couple different ways. We'll do the present value with an annuity calculation now. So this is going to be negative present value, shift 9, rate is going to be the 11%, comma, number of periods is going to be 20 periods, and then comma, and we're going to pick up then the payment, which is the 180. Once again, we get the 1,433.44. We could do this whole thing breaking it down to an annuity of 1 for 20 annuity of 1s. I'm sorry, so 20 present values of 1 as opposed to a 20 period annuity by doing it this way, running balance 1, 2. I'm going to select those two, autofill all the way down, autofill. Center, home tab, alignment, center. Payment is going to be then the 180. Then we'll simply present value of 1 all the way down. So I'm going to say negative PV, shift 9. Rate is going to be the 11%, comma, number of periods 1, comma, because it's not an annuity, future value 180. There we have it. So there's the 162. Let's do it again. Payment's going to be the same, equals the payment 180. Present value, now negative PV, shift 9, rate 11%, comma, number of periods now 2 periods out, comma, because it's not an annuity, but present value of 1, and there's the 180 again. Now adding the prior balance plus the current balance, and so on. We're going to add this all the way down to the 20 payments. We need to absolute reference anything that is outside typically of the table we are working in, which is going to be that 11%, which is in cell E6. So present value over here, E6. I'm going to put my cursor in there and F4 on the keyboard, putting a $sign before the E and 6, absolutizing it. Enter. We only need a mixed reference, by the way, but absolute is easier, so I'm just going to do that. And then we're going to autofill it on down. Autofill it down. And there we have it. Answer has been gotten to again in a different way. Now note that you could just add one more row here and why don't I just present value the ending payment of the bond too and just finish this thing off. So I could say let's copy this down one more row. This will also be 20 periods out, not 21 periods, but 20. And I'm just going to pick up the $1,000, the $1,000 over here for the bond amount, and then that will give us our ending balance, and we don't even need the annuity table that way. We would just basically do present values all the way down. Present value all the way down. So that we could do that is another format, but we will continue with our process here. We can also calculate this, of course, with the tables, so that always is a good time to do. So we're going to start with the 180. Making sure we're picking up the proper table, which is going to be the annuity present value, 11%, 20 periods, 11% and 20 periods, 7.9633, 7.9633, 7.9633, 7.9633, 7.9633, and then multiply this out. This is the 180 times the 7.9633. Gives us the 1433.39 once again. So now let's do the other part, which is to take the present value of the 1 payment, the 1,000. That's a present value of 1, not an annuity. Present value formula down below. PV equals the future value, the 1,000, over or times 1 over the 1 plus the rate, which is going to be, I'm going to make it green again, this 11%. And that's the market rate. That's the key to the power of periods 20. So let's do it. I'm going to do it in the table format again. We're going to say there's the 1,000, and then I'm pulling the 1 plus R to the N in the inner column. 1 R, the 11%, the green one. Home tab, numbers, percentify, home tab, font, underline, trusty sum function, SUM, shift 9. And then we'll percentify that. Home tab numbers, percentify number of periods. In our case, years, that being 20. Underline, home tab font, underline. Bringing that on into the outer column. This is going to be then the 111%, shift 6, caret, in other words, 20. Adding decimals, home tab numbers, more action needed. And then home tab font, underline. Finally, we can do the division problem, taking the good old numerator, but divided by the denominator. And then adding a couple decimals, home numbers, couple decimals. There we have that. Then if we add this to the present value of the annuity we got last time, which I'm going to get it not from the table time because this one's a little bit more exact from the actual Excel formula, that should be the ending value or price of the bond at the 1557.43, which is what we got also when we did this running balance, 1557, that we rounded there, but same thing. Okay, so now let's do this component. So that's it. Let's do this one a couple different ways. Let's do it the magic way with Excel function. Negative present value. This is the present value of one calculation. PV, shift 9, rate 11%, comma, number of periods 20, comma, because it's not an annuity. And then future value 1,000. So there we have it again. For this amount, table time. Let's do it with the tables. Another way we can do basically the same thing. So let's do it the other way, and same thing, new way. This is going to be 11%, 20 periods, 11% on the tables. This is making sure we got the proper table now, present value of 1. 20 periods is down here, 1120. That's 0.1240, 0.124, 0.124, 0.124, 0.124. And this is going to be equal to 1,000 times the 0.124, giving us the 124. Okay, let's go all the way back. I'm going to holding down the left arrow all the way back. I'm going to scroll down till I get to the next set of numbers here, where we will now focus in on this 10%. Let's imagine the 10%. Be much the same because once again, the market rate is less than the rate that we would imagine on the actual bond, and therefore we as the seller have the advantage. We're going to say, hey, you can't get 18% anywhere else. We're going to sell you this thing for something above the $1,000 face amount. So that's what we'll do here, and then next time we'll have the kind of reverse situation where the market rate is higher. Let's do this again. So we're going to present value the annuity now. So that's going to be P times 1 minus 1 plus R to the negative N over R. I'm going to put P in the outer column. P is going to be the 1,000 times the 18%, the amount that we would imagine on the actual bond itself. So we have the 8, that's going to be that 180. Then we're going to say the 1 minus the 1 plus R. I'm going to put the 1 in its own column. Then I'm going to pick up this 1 plus R to the negative N. 1 plus R, which is now 10%, market rate, not the rate on the bond. Home tab, number, percentify, home tab font, underline, trusty sum function equals SUM, shift 9. And then we'll percentify that, home tab numbers, percentify. And then to the negative number of periods, 20. Underline, home tab font, the little U for underline with a line under it, expressing what it's doing. Then it's going to be equals the 110 shift 6 caret, in other words, to the power of negative 20. Let's add some decimals so we can see some action number group. There's the action. There's the action. Home tab font underline. Then we can subtract this out now. We're going to subtract this out. This is the 1 minus that thing that we just came to, that big long decimal thing. Then home tab number, decimalizing it again. And then that's the whole numerator finally. Now the denominator is just simply the 10%, the rate. Home tab numbers, percentify, home tab font, underline. Then we'll take the good old numerator in the outer column, divide it by the denominator, add decimals, home tab numbers, decimalize it, and then home tab font, underline it, and then finally multiplying out the outer column, the 180 times that thing we just got to. Let's see some pennies if we could. Home tab, numbers, couple pennies, 44 pennies. Or maybe it was like 4 dimes and like 4 pennies, but or something. Anyway, now let's go ahead and do this again with the easy way. Let's go over here and do it the magic way with the Excel function. Negative present value, shift 9, rate 10%, number of periods is going to be the 20, comma, and then annuity formula, the payment is going to be the 180, and there we have it again. So there we have it again. Let's do it with a series of present value of 1 calculations. So we can break down the annuity into present value of 1, 1, 2, and then we're going to copy these cells down. Excel is so smart that it can figure out the pattern there. 1, 2, and followed by 3. Home tab, alignment, center, payment is going to be 180. We'll do the present value of 1 now. Equals or negative PV, shift 9, rate 10%, comma, number of periods 1, because this is just 1 period out, comma, comma, because it's not an annuity, but present value of 1, there's the 180. So that's the value. Let's do it again. Payment's going to be the same because it's an annuity that we're present valuing 1. And then this is going to be negative present value, shift 9, rate is going to be the 10%, comma, number of periods now 2 because it's 2 periods out, comma, comma, because it's not an annuity, and then the future value is 180. Then we'll copy the last present value that we took back to the second year present value that we took back, and then we're going to do this all the way down. But if there's anything outside the table that we're pulling from, like that 10% on E62, we will need to absolutize it, making it an absolute reference. So within the present value formula, we will double click on it. In E62, putting our cursor there, selecting F4 on the keyboard, $ before E and 62. You only need a mixed reference, but absolute reference works, and it's easy. So we're going to then select those 3 cells, use the autofill handle to autofill with it. That's what you do with the autofill handles. You fill things automatically. And there's the 1,532. Once again, 1,532. No pennies this time. We'll leave the pennies off. Also note that we could then add 1 more row down here and just say, why don't I just not even do the annuity and just add another one? This one's also at 20, and just pick this up as the bond value, which is going to be taken back as well. That's the second component, which would give us to our end result right there, the 1681. So we could do that. I'll make this yellow. So that's one format, one way that we can calculate this. All right, so then let's do it again, and now we'll do the tables. That's another way we can do this with the tables. 180, and then looking up the table, making sure we got the proper table. We're looking 10% and 20. Annuity table, present value, 10%, 20 periods, 10%, 20 periods. That's going to be 8.5136, 8.5136, 8.5136, 8.5136, 8.5136. Multiplying 180 times 8.5136 gives us once again the 153245, close to, not exact to what we got before because tables are rounded to 4 digits. Let's then do the second part now. Second part, which is present valuing the one thing, that 1,000 back to the current period. Formula, present value equals the future value, 1,000 times 1 over 1 plus R, which is going to be 10%. That's the one we're on, 10%. To the n, number of periods, 20. Breaking that out in our table here, we're picking up the future value is going to be the 1,000, and then we're going to say this is 1. Rate is going to be the green one down there, 10%. The market rate, not the rate on the bond. Let's percentify that. Home tab numbers, percentify. Home tab font, underline. Summing it up with the trusty sum equals SUM, shift 9. Summing those two up, making it a percent. Home tab numbers, make it a percent. And then we're going to take this to the power of number of periods, in our case years, 20. Underline, home tab font, underline. Bringing this on into the outer column as we then say equals to calculate the 110%, shift 6, caret 20, power of 20, number of periods. Add some decimals so we can see a bit more of what's going on. Number group, a little bit more of what's going on right there. And then home tab font, underline. Then we can then divide this thing out. Numerator divided by the denominator. Home tab number, pennies added, 64 of them. Then we can say, well, this is what we got on the annuity last time. So like last time, the annuity calculated out to this, the 1,532.44. If I add that to the present value of the single payment, we get to that 1,681.09. That then matching what we got in our running balance table, 1,681, although there's no pennies here because we didn't add them, but it's like the same number anyways, that's rounded. Now let's do it the magic way. We're going to get to this number again, the magic way. That's using Excel, the magic way. Negative present value, shift 9, rate 10%, comma, number of periods 20, and then comma, comma, because it's not an annuity, but present value of 1, future value 1,000. There it is again. Let's do it one more time with the tables. Table, time. Time for the tables. When it's time for the tables, we call it table time. So we got the 10% and the 20, 10 and 20. Looking 10 and 20 here. There's the 10. Going down to the 20, making sure we got the proper table. This is the present value of one table, which is 0.1486, 0.1486, 0.1486, 0.1486, 0.1486. This equals the 1,000 times 0.1486. There's the 14860 again. I'm going to scroll all the way to the left, and we'll do this one more time. Then I'm going to scroll down to the last scenario we have, which is the 20%. So now we're not looking as good. Something crazy's happened in the market. There's 20% and 18% here. So inflation has anyway. So now we're going to try to sell our bonds, and we're saying, hey, we got our bonds to sell, and the people on the market are saying, look, there's bonds all over the place right now. We can get a 20% return on the bonds. So yeah, 18, that's nothing. We can get 20 elsewhere. And we're like, all right, we'll sell the bond for something less than the 1,000. So when we get the price, then I can't change the 18%, but we're going to have to sell the bond then at a discount. So we expect then to get to a price less than the 1,000 this time. So let's do it again, same thing. And we're going to say P times 1 minus 1 plus R to the negative N over R. That's the annuity function. Again, same thing. So I'll do it a little bit faster here. 1,000 is going to be on the outside. That's wrong. Hold on. 1,000 times 18% is our starting point. Then we'll pick up the 1. I'll put that in the inner column. Then we'll pull this inside again. This is going to be 1. Rate is going to be now 20%. Percentifying that. Home tab number. Percentify. Underline. Int equals SUM of those two items. Percentify, home tab numbers, percentify, taking it to the power of the number of periods, negative 20, underline, home tab font, underline, pulling this into then the outer column as we say equals the 120 shift 6 caret negative 20, adding some decimals to see action, home tab numbers, decimalizing it, there's the action, home tab font, underline. Then we could subtract, finally getting the numerator. This equals the 1 minus that decimalized number. We then need to decimalize the new number, home tab numbers, decimalize again. And then the rate is going to be 20% underneath, rate. Percentifying the rate, underlining that item. Then numerator and denominator, going to be dividing them out. Numerator then divided by the denominator. Adding decimals, home tab numbers, decimalize, underline, and then multiplying finally the outer column, the 180 times that final decimalized number, adding a couple pennies, home tab number, a couple pennies. There's the present value of the annuity. Let's do it again the magic way with the Excel formula, which is just negative present value shift 9. Rate is now 20%, comma, number of periods is now 20. Got 2020 here, 2020. Just like my vision, like I wish my vision and it was. There's 180, and that's the payment. And so there we have it again. Let's do it with breaking the annuity out into a series of payments of present value of 1, 1, 2. We're going to select those two items and then autofill them on down. And then we'll say home tab and alignment and center. The payment's going to be then 180. We're going to use our present value equals negative PV shift 9 rate 20%, comma, number of periods is now 20 right there, comma, and then I need 2 commas. Hold on, comma, comma, chameleon. And then the future value is going to be, hold on a second. Sorry about that. The number of periods is, let's just do the whole thing again. It's going to be negative present value, shift 9. The rate is going to be the 20%, comma, number of periods is 1, because this is 1 period out, comma, comma, future value is 180. Okay, so that's going to be our starting point. Then the second payment is the same. The present value negative, present value shift 9, rate is going to be the 20%, comma, number of periods now 2, comma, comma, future value 180. Running balance, prior balance, plus the current balance. We're going to copy this down, but before we do, we need to make anything outside the table from a data set 20% here in E119 absolute. Going to double click on the present value. There's the E119, selecting F4 on the keyboard, $ before the E and 119, enter. Selecting those 3 then, autofill handle, using the autofill handle to autofill, hence the name. Then we can then take it one more time down. So this is our end result there, although there's no pennies. We could say, let's just do this one more time, also period 20, and make this for the 1,000 amount, the amount at the end of the whole process here of the bond payment. And that would give us to our ending number. That would get us to our ending number. So we expect at the end of this to be at that 903 about, without pennies. It's rounded. All right, let's do it again with the tables. Time for the tables. That's why we call it table time. Table time. It's going to be now 20 and 2020. 2020. 2020. That's way over here. I'm going to have to scroll down a little bit. Hold on a second. I can't see the 20. There it is. 2020. That's 4.8696, 4.8696, 4.8696, 4.8696, multiplying 180 times 4.8696. There we have it once again. All right, second component to this is to present value 1, the end payment, that 1,000, using the present value formula, PV equals future value times 1 or over 1 plus r to the negative n, pulling then the future value to the outer column, that being the 1,000. Then we're going to say 1 plus the rate. The rate is now the 20%, which I'm going to make green so I don't pick up the wrong rate again. So I want to make that one green. Less likely to mess up that way. Home tab, numbers, percentify, home tab, font, underline, trusty sum, SUM, shift 9. Making that a percent, home tab numbers percent, taking it to the period of 20 periods, underlining, home tab font, underline, outer column now at 120%, shift 6, caret 20 periods, and then home tab numbers percentifying that, and then home tab font underlining that, and then taking the numerator equals the numerator outer column divided by the denominator, adding a couple pennies, home tab numbers, couple pennies. So there we have that. If we add that to what we got last time we got to the this 876, and if we add that to what we got this time, we're going to get to the 902.61. So it's something, of course, again, less than the face amount. So then we could do the same thing with the present value, the magic way, negative PV, shift 9. The rate is going to be then this 20%, comma, number of periods is going to be 20, comma, comma, because it's not an annuity. Future value of 1,000. There's the 2608 again. Finally, let's do it with the tables. Tables, 1,000, looking 2020 down below, 2020. That's going to be the 0.0261. 0.0261. 0.0261 equals the 1,000 times the 0.0261. There's the 2610, about, little different due to rounding, tables rounding 4 digits.